Hi, my name is George Dagnino. I'm the editor of the Peter Dac Portfolio Strategy and Management. There are several ways to make forecasts, and there are several models. What I'm going to do today, I'm going to use an approach that, by the way, when McGraw-Hill read my book, saw my notes and saw my website, asked me to write a book about it, and it's based on how business makes decision and how the way business is making decision is what drives the markets. This is one way to look at the economy and the financial markets. In other words, business people are so smart that they filter all this noise coming from Washington, from all over the world, and then they have to decide how much they have to produce, how much they have to buy, how much they have to sell, how much inventories, how much everything. And all these decisions eventually are reflected in the economy. Let me show you. It's a different way of looking at things, but it cuts the noise, I think. Okay, let's see what happens. The economy or the business cycle can be divided in four phases. There is the phase when business starts picking up, the phase where business is very strong, and eventually the strength creates rising commodities, inflation. Then there is a third phase when business recognizes that earnings start growing more slowly, and consumers purchasing power decreases. Then there is a slowdown. The slowdown is caused by rising inflation, rising interest rates, and then this is the most difficult thing for investors to face. And then once the excesses created in the phases during the phases 1 and 2 are finally corrected, then the economy start picking up again. So let me go more into detail now. This is the business cycle. This is when things pick up and strengthen following a slowdown. This is confidence builds up, production is increased, and then towards the end of phase 2, inflation starts rising. Then, of course, rising inflation slows down the purchasing power of consumers. Business keeps on producing. Eventually, they produce too much, and their earnings start slowing down because carrying inventory is a cost quite a bit. And so phase 3 starts to slow down. And then in phase 4, this is when inflation, interest rates, the economy starts slowing down quite severely, and usually we have a recession. Right now, where we are here. And this is an important phase for investors. So let me go more into detail and see how and when this phase will end so that we can start making some money. This approach that I'm following is based on how well business is manage inventories, and I will show you how is a very important, very important development. And of course, in 2020, with the Federal Reserve and the government printing money like crazy, people found a lot of money in their pockets. So what is the reaction of business? Try to produce as much as they could. So as much as toilet paper as they could, as much as autos as they could, as much of everything as they could. And of course, this is why we had supply chain disruptions, because everybody was trying to manufacture as much as they could because people were buying like crazy. So what happened? A good businessman, well, we had to talk about that, if that's a good idea or not. But what they did, they built a lot of inventories because, we need a lot of toilet paper because people want a lot of toilet paper. So they start manufacturing like crazy. And of course, let's see now what happens. This is the way business reacts to growing demand. They build inventories. And then you can see these are mini cycles that are very important, by the way. In other videos I showed, in my articles, I show how they drive the stock market in various sectors. But here, for this purpose of this presentation, again, after all that money that was printed by the government and the Fed, production, of course, inventory started rising. By the way, this is after inflation, so these are real dollars. They started accumulating inventories like crazy. Of course, now what happens? Well, by the way, notice that inventories were growing this year over year around 15, 17% year over year. Notice that when over the long term, inventories grow at anywhere between 0 and 4 5%. So here 15% was huge. So obviously, with all the production, all the money around, there was inflation. And what the inflation caused consumers to just spend less. So demand started slowing down. And what is happening now? You see here, now inventories are coming down. Now, when you reduce, if you want to reduce inventories, you have, as a business, you have to do several things. They're very, very simple. First of all, you got to cut prices because you want to get rid of inventories, because even carrying inventories costs you money, and earnings, by the way, have a negative impact on earnings. So you start cutting prices, which is good news for inflation. The other things you do, you start buying less commodities because you need less raw materials. So commodities weaken from crude oil because you need less energy to produce, and so on. And then the other things that also declines are interest rates. Why? Because you don't have to borrow to finance the production and the carrying of inventories. So when inventories business decides to act and slow down the growth in inventories to historical norms, you should see interest rates, commodities, and inflation to decline. So what we are seeing in the previous slide is that business is recognizing that they had too much inventories. Why do they know that they have too much inventories? Because now earnings are slowing down. That's the way it's inevitable. So they had to do something. And they have to do something means that they have to become very defensive in the way they run their show. And let's see what they do. This is the growth in industrial production. Okay, so obviously they have produced a lot to build up inventories, but they realized that inventories were rising too fast. So what happens now to production? After, obviously here they saw a peak in earnings growth. They had to cut production. So that's the first reaction in managing inventories. You reduce working hours, which by the way they're reducing, they're being cut, and you reduces the growth the growth in production, which is now year over year is slightly negative. So this business is now reacting. It's not the Fed, it's not this, and it's not that, all the things you read and you hear on the TV channels. This is business making decision. They are reducing production, and therefore they're causing the economy to slow down because they need to correct the excess of inventories. But these are also has other repercussions. Let's see what they are. Okay, so what we see now that business realizes that earnings are coming down, slowing down because of excessive inventories that are growing at double digits when usually they grow only at 3%. So obviously they have to reduce inventory so that they cut their losses, so to speak. Now, in order to cut inventories, they have to make several steps. The first step we saw is to slow down production. So that's the first step. In fact, now production is stalling and probably will continue to decline because inventories are rising way too rapidly compared to the historical range. Let's see now what else they have to do. So in order to reduce inventories, they have to produce less, and to produce less, they have to buy fewer raw materials. And this is the price of commodities as they react to changes in demand by business. Here you see commodities rising very fast because business were ramping up production to build inventories. Here when inventories, they realized that income earnings were sort of slowing down, and so they decided to start reducing inventories, therefore cutting production. As they reduced production, they bought fewer raw materials, so raw material prices now, commodities are weak, and they're likely to stay weak. Why? Because again, inventory is still growing around 9% year over year when they should be growing around 4%, 3% year over year after inflation. That's what I'm talking about. Let's see what happens next. Of course, when you want to build a lot of inventories because of the famous soaring demand, you need raw materials, but you need something else. You got to borrow money. You have to borrow money because you have to buy the raw materials. You have to hire people. You have to do many things, improve capacity, maybe buy new machinery. So the change in inventory policy, what the business does, has an impact on the credit markets. Let's see how. This is a very interesting chart because it has a tremendous amount of information. Anyway, this is the green is the market set yield on the 2-year Treasury note, and the blue line is the Federal Reserve, the Fed funds rate as set by the upper limit as set by the Fed. Now, in 2020, we saw there was a lot of money printed by the government and the Fed, and the reaction by business was to ramp up production here. You notice that. We talked that. The outcome was also rising commodities. Then, as the pipeline and the pressure grew on the money markets, eventually, this demand for money by business, and again, the demand for money by business, somehow in 2021 started going up. The green line. This is the first effect that the economy was overheating because of the effect, this enormous amount of production done by business. The interesting thing is that notice that the Fed reacted to the market setting of interest rates roughly a year after that. So the markets were way ahead of the Fed. The Fed was, the Fed follows the markets. It doesn't set the market. So the markets were already saying because of the action by business. But now notice here what is happening. What did I say in the previous charts? That business is now reducing production. They are reducing the purchases of raw materials, and raw materials are coming down. Now they are cutting borrowing. Why? Because they need less money to finance inventories, to finance the purchases of raw materials, to finance the hiring of new people. So this commodity, this level of interest rates is likely to follow the trend of commodities because of this enormous inventory correction that we are going through in the coming months. So now the big question, I said, what is the outlook? So let's say the next 3 to 6 months. Well, it depends. Remember, the increase in inflation is reducing the purchasing power of individuals. So the business is contracting, is laying off people, so income is being cut. They're reducing commodities, they're reducing prices, so inflation is coming down. So there is all this process that is going. How long this process is going to last? Well, we have to look at sales. And this is what really is happening and will drive business defensive posture for many, many months. Again, this is the sales at the wholesaler, at the merchant level, wholesalers level. Here, of course, sales were strong, therefore production was strong, therefore there a lot of buying of raw materials, borrowing, and all that. But look at what happens now to sales. All that money people spend it, they don't have it anymore. So what happens to sales? Now they're contracting. And remember what I said before, inventories are still growing at 9.4%, and usually the growth rate of sales and inventories are roughly around 3 to 5, 6%, between 0 and 5%, 6%. So the process of going from 9% growth to 3% is going to last many, many more months. In the process, all the trends that I discussed before, commodities, interest rates, and earnings, are going to come down. So when will really things will start improving again? Well, when business is going to start making money again. And when will they start making money again? When inventories are growing at the same level of sales. That's when profits start improving. So until that time, the 9% growth in inventories comes down to 0, 3%. It's going to take many, many more months. In the process, earnings are going to come down, commodities are going to come down, interest rates are going to come down. And of course, the poor performance in earnings will have an impact on on the stock market. So I started by telling you showing you the curve of the business cycle, and I told you that we were in phase 4. What is phase 4? It's exactly the process that I discussed here. Is the phase where all the excesses that have been created in previous phases because of some crazy things that the government and the Fed have done, and this is where business regroups and tries to recreate an environment leading to higher profitability. In the process, we all are going to pay. Meaning what? Right now, we all trying to buy less because of rising inflation, business because of the conditions that they have. They are trying to cut inventories, therefore inflation is going to come down because the only way to cut inventory is cutting prices, cutting production. The outcome will be lower commodities, lower interest rates, which is good news for bonds, and of course lower earnings, which is bad news for stocks. And this is the process that will continue until sales and inventories are back in line. Again, I will keep track of this process because it's a very interesting one. Notice that I never mentioned the word Fed. I know it's a different approach. The Fed is just an endogenous, as they say, phenomenon. They just print a lot of money and then see what happens. Anyway, this is what I had to say. So it's still a cautious environment. Those of you who want to find out more about what I'm doing in my work, I write every week a report called the Peter Dack Portfolio Strategy and Management. You can get a free subscription, no credit card required. You can just, all my articles are there and so on. So this is the book that the McGraw-Hill Education asked me to write and paid me to write it. Is Profiting in Bull or Bear Markets, How Business Cycles Impact the Financial Market. I had very good review. Is a very detailed description of how business cycle works and the impact on the financial markets. These two other books are sort of this is a test that I run on ETFs using moving averages. I wanted to find out what is the impact of what kind of income profits you could make with portfolios using ETFs and moving averages. This is interesting. This is a recap of everything I really know. Very summarized. It goes from the broad macro strategy to how to select stocks. And all my articles are in www.peterdack.com. You can also follow me on YouTube at George Dagnino 5017. This is where all my videos are. I update my charts and some thoughts on Twitter at George Dagnino. Again, I thank you very, very much for following this video. And again, this is only provided for information and educational purposes only. It's not investment advice, please. You have to ask your financial advisor for that. Again, thank you very much, and I'll see you really soon. Take care of yourself. Have a nice day.